All right, guys, welcome to another episode of Upstream with RiverX. I'm your host, Kieran Berry. Thank you for joining us today. Before we get into it, we've got our standard disclaimer. So anything that we say or you hear on this podcast today is not financial advice. This is for general information purposes only. And today I've got a special guest with me, Reuben Way from Azura Financial. Reuben, g'day. Thanks for joining us.
Hey, mate. Thank you. Got to admit, this is my first podcast, so you're popping the cherry. Looking forward to getting into it.
Well, welcome aboard, mate. And I guess for the benefit of our listeners, if you could just tell them a little bit about yourself in terms of who you are and what you do.
Yeah, so I'm a mortgage broker at Azura Financial, and essentially I'm a mortgage broker for the private and wealth clients. So over the last couple of years, we've kind of purpose-built the toolkit to cater for the needs of those private and wealth clients, in addition to your kind of line and length home loans as well.
Mm-hmm. And tell me a bit about Reuben Way, the person, like your journey, I guess, from childhood, sporting achievements, and then what brought you into mortgage broking as a profession.
Yeah, absolutely. So background is professional sport, played a lot of soccer as a kid. My first pro contract was 19 with the Gold Coast United. The owner of that club was Clive Palmer. And so we had a good first year that year. It was a really good experience. For those who don't know, Clive Palmer is almost Australia's answer to Trump in the sense that he's really colourful. But being 19 on the Gold Coast with a pro contract, I was a little bit of a party boy back then and got into a bit of trouble. And I didn't get re-signed for that next year. So that was the first year that I realised that I wasn't bulletproof. Went back to uni, moved down to Melbourne to kind of re-establish myself as a footballer and whatever else I wanted to do then. The A-League, the soccer, it's not your major code. So it was pretty obvious to me that, what I could earn playing soccer, there was a little bit of there was going to be an end date there. And so I was really always keen on an understanding of what was next for me. And I started my company back in 2015, which was, day one.
And what was that company you started? Was that a mortgage broking business that you started in 2015?
Yeah, correct. Mortgage broking business.
Mm-hmm. And what was that called?
Oh, so the company was me out of trading out of that. And I started at Aussie Home Loans. That's kind of like where I kind of cut my teeth. Yeah. Those first 2 years at Aussie Home Loans. And that was down in Melbourne. And I quickly realised that, the type of person that I was dealing with at Aussie Home Loans, I wanted to kind of grow and evolve quite quickly. And I guess that mindset to kind of keep going kind of led me to, that next step and then that next step. And, I'm here now and we're doing a lot of other different clients that I'm dealing with when I first started.
And now you're working out of Azura. And can you tell me a bit about Azura Financial in terms of who they are and their typical client?
Azura Financial, I think they're the second largest privately owned mortgage brokers business. They've been in the top 25 brokerage of the country for the last probably 10 years. And it's probably more understood the Azura business is made up of a lot of other businesses. So myself would be one. And I guess to a franchise model type thing, there's probably 16 other brokers that are under Azura. We've got a great office in Double Bay, and everyone kind of runs and operates their business within that.
And what differentiates you as a practice to other mortgage broking firms?
So as the business, probably the volume, and I guess the kind of the relationships that all the brokers have with their different partners. I think we'll write over nearly 2 billion this financial year, coming FY25 or FY26, sorry. And when you're doing a lot of deals, you're speaking to a lot of people. You've got to get your processes and efficiencies right. And that's just part of the evolution to get into where you're going.
And with your business, I've had some positive engagement with you on a personal level and obviously through my business. But how does it work? Is it your stock standard real estate sort of debt that you do, or do you look at company loans? Do you look at alternate structures? Like, how does it work with Azura in terms of the different options available?
Yeah, so we kind of cover the broad base that you're going to find in the market. One thing for my business is when I moved up to Sydney, probably 4 years ago, I learned two things. One was the real estate market was ultra competitive, and two, that wealth advisors didn't know a lot about debt. And so that's where I found the opportunity to kind of move more into not just the line and length home loans with residential, commercial property, business funding, but more so about what are some of these private clients and wealth clients? What are their needs? They're still transacting. What are they doing? How can we help serve that and facilitate that? And so you'll find that, the composition of the loans that I'm doing per month, half of it's probably like the line and length home loan type stuff, your residential investors, owner occupiers, upgraders. But then the other half is going to be looking at potentially bridging finance, lending against RSUs, stocks, shares, equities, even reverse mortgages, how to access sometimes the funding there, and even some family office type stuff, which are really, really handy.
And then when someone comes to you, are they normally looking to get a brand new facility, or are they coming to you to get a more competitive rate on something already established? Or what's the general mix there? Yeah,
it depends on the origination. So in my personal network, which is what we do a lot on the line and length home loans, they're transacting, as in they're either upgrading the owner occupier, they either want to consolidate some debt, they want to evolve from residential investment into commercial investment. They want to, start an SMSF or understand lending in SMSF. So that's a lot of the stuff, I guess, in that bucket. But more so to where you guys play in the private side is we get a lot of, I guess, the originations come from the advisor. So they're going to have an issue, or their client's going to have an issue that they come to the advisor with, and then I generally get the phone call there. For example, a lot of the banks have pulled back from a lot of the capability stuff. They're not doing development financing so well. They're not doing bridging financing so well. When you're dealing with a bank, you're generally going to get a cheaper rate, but it's going to be a longer and extensive process with a lot of documentation. So having access to a lot of other funders that are outside of that traditional banking realm allows us to then, I guess, offer a lending strategy that can meet the need of the client.
Yeah, and I think when we sit down with the client, part of that scoping, part of the initial conversation, it's about looking at them holistically, understanding where their assets and liabilities sit, and then trying to make sure that they've got two things happening, that they're saving as much as they can, and that they have the right network to help them go forward to achieve their goals, whether that's establishing a broader property portfolio or refinancing to help them achieve something different. A common trend that I've seen is when we'll sit down with a client, we'll have a look at someone and we'll look at their rate with their existing bank, and then we'll see that a competing bank will offer them a sharper rate. Is that a common scenario for you where banks will treat new clients more favourably than existing?
Yeah, that's a general consensus. New to bank, they'll kind of want to offer a better rate than the existing bank, obviously, to win the business.
So how does that work? Like, so why would, in your experience, why wouldn't, say I'm with Westpac today and I look and I can get ANZ at what's the spread there? Is it a couple of 100 basis points normally? Or, is it?
Give or take 0.1 to 0.3, you'd say, with the majors.
So 10 to 30 basis points is kind of your margin. Why is it that they don't just refinance internally? Does that happen? Do you still get to participate in that opportunity if you refi internally, or only if they move?
Yeah, it depends. So if you try to go through the pricing channel, because we'll price every deal up once we understand what the loan amount is and what the client's trying to do, we'll go to the pricing team. We'll say, hey, here's the situation. Here's what the client wants to do. Here's what everyone else in the market are doing. They want to hang around. Are you going to meet the market? And they'll either say yes or no.
Yeah.
So if they say no, then our next thing is to kind of go through the discharge team, kind of freak them out and say, hey, we're leaving. And then if they come back to us again and say, all right, we'll meet you, then we've got the outcome for the client. Otherwise, the offer's there on the table for the client to move elsewhere.
And I guess one of the things that we're seeing now is that interest rate, the cost of living is massive focus right now. With the offshore conflict, you've got petrol prices going up, so everyone is sort of looking at where they can sharpen costs more and more. Are you seeing an increased inquiry from people looking to refinance loans at sharper rates on the back of these events?
Yes and no. Like, it depends. Like, my client base is probably a little bit more opportunistic than they are trying to save a buck. In that sense. I'll give you an example. We had a guy who's got about $5 million of shares and he's looking to gear it. Your generic margin loan with the banks is going to be anywhere between 6.5% to 7%, whereas we've got a family office that'll do something like that at 3% to 4%. So all of a sudden, from the wealth advisor's perspective, who introduced us the deal, there's an arbitrage opportunity there.
Is that a Lombard facility that they're doing?
Yeah, similar to a Lombard facility. The only difference is that there's generally a fixed term, and so that allows the funder or the family office to kind of then go and do what they need to on their end.
I guess one thing that'd be useful for our clients, because we've got a lot of clients that have stock, and there's a clear arbitrage market where you can go and buy listed debt securities that offer a better yield than what the margin will charge. How does a Lombard facility work? Is that where they're borrowing from in another currency and bringing it back to Australia? Is that how the family office is lending in this scenario?
Yeah, so they've got a presence across the globe. The only difficulty lending against different shares would probably be Shanghai, because they're quite restrictive. But the strategy is kind of dependent on the client. So to give you more context, a guy's still got a home loan. He's got about $1 million in his home loan, but he's got all these shares that are unencumbered. So we lent against the shares to pay out the home loan, and so then all of a sudden the non-deductible debt's gone. Yeah. And then with the expiry of that Lombard loan, as you call it, we'll then get out an investment loan to then pay back the share loan. Okay. So then all of a sudden his loan's gone from non-deductible home loan debt to now an investment debt.
Okay. And how do you work with the advisor then on the strategy around that? Do you work with them on the LVRs of the individual stocks within the portfolio to make that all marry up? And is there an opportunity, I guess, for your wholesale clients to come and have a conversation about that?
Yeah, absolutely. So first thing is, as a mortgage broker, we can't give advice. So we're heavily reliant on the playbook or the roadmap that the advisor gives to us, or the brief that comes from the advisor or the client to us. And that's how we want to see our business move forward as well.
Well, my question was more about who advises. So we would advise on the underlying equities.
Correct.
And then you would provide the facility. And then in terms of limitations on those facilities, what's your minimum threshold for a portfolio and I guess a lend of that nature?
There's no real minimum, particularly with this family office. They're doing things 50 mil plus. We've got inquiries at the moment for a lot higher than that. And so they're very, very capable in that sense.
What's the minimum though? So if you came in, if I had a family with, and let's just put this in terms of an everyday Australian investor, we see a lot of clients that are deemed as wholesale investors. They might have $2 or $3 million of investable assets that are listed on the ASX. That's a common scenario you mentioned, where someone's got a residential property in Sydney with a few $1 million of debt against it. Is that the type of size where you could borrow against the share portfolio, or is that too small?
Yeah, absolutely. Yeah, anything about $800 to $1 million as a starting point or barrier to entry. Anything above that.
Okay, cool. And I guess in terms of accessibility to that, is that restricted to wholesale only, or can retail investors look at
No, as long as the shares are listed.
Okay. Yeah. Okay.
As long as they're listed.
Okay. That's something we haven't talked about before, so maybe we'll talk about that one offline. Back to building the business, I'm curious to learn a little bit more about the movement from the sporting career into the business building aspect of what you do, and I guess some of the takeaways from that, and sort of how it helped you shape your business and who you are today.
Yeah.
So when you were transitioning out of sport, how did you go about building your business? How did that work, stepping into an Aussie home loans franchise?
Yeah, so good question. So when I was about 25 was when I started that company, when I first got into mortgage broking, and that was under the pretense that the A-League dream, or even if I did make the A-League and was shooting the lights out, the kind of income that you earn, because it's not a top tier, I guess, Australian sport, was never going to get me to where I wanted to go, especially if you want to live in a major city. So my last professional year was 2018, and in between that I was playing semi-pro. So we were training 3 or 4 nights a week and then playing on the weekends. So that enabled the time for me to work on the business during the week, and then obviously go to training and play on the weekends. Once I then went professional, I had to then make a decision over how long am I going to do this for. So I did play the year in New Zealand, went out to Wellington, Phoenix, and played with the Kiwis over there, which was a great experience. But that kind of cemented my decision to move into business, and it was a clear switch between, the boardroom was my new change room then, and I could see the next 20, 30 years of my life getting into business. And one of the things that I've enjoyed over that journey is really understanding the exchange of information that you learn as an athlete. So understanding, teams, leadership, discipline, application, preparation. Why do a preseason? Because you can't rock up to day one in the league and think you're going to be competitive. Understanding how clubs work. You're a player. What's the management staff? The board, the ownership. So understanding a lot of those things through actually playing. And it was probably, mate, I didn't know what an end of trip facility was until I was like, until I was like 28.
Yeah.
And a lot of those athletes have an issue, have a challenge understanding all of those, I guess, principles, key man risk for another one. Understanding those principles and being able to exchange your learning from on the pitch to into the business world. And that usually takes 3 to 4 years. And it's a bit daunting for people because you rock up to an office and you hear bubbler chat. And you hear end of trip facilities and you don't know what it is. What am I doing here?
What are we doing? Yeah.
Yeah.
I've got several former athletes that have brought into my business. So one is a former Queensland State of Origin and Australian player from the NRL. The other is now a former professional AFL player as well. He's started with us. He's literally retired in the last few years. One of the things I've noticed with those guys is they're normally first one in, last one out. For both of them, but there's also a certain cadence and discipline about the business in terms of how they grow their business. Would you say those attributes would have helped you early on in terms of actually building the practice because you would have had to build it from zero?
Yeah, 100%. It's in the fabric of what you do. You consciously, you're always very conscious of where you put your time and effort, and if it's not towards the ultimate goal or playing or being in best nick or achieving your numbers or weight numbers or whatnot, you have to wake up and weigh yourself every day.
Yeah.
So there's being able to having to do that consistently. It's just part of the fabric of your being. And then when you reposition your goal set from, okay, great, now I'm not athletic. Now I just need to move that into business.
Yeah.
And that's been a big help.
And does that help with so with your business? I imagine it would be quite like mine in the sense that you're client facing, you've got client expectations similar as you'd have in your playing environment, but you'd also have a certain workload that you need to meet each and every day. And do you find that translates into things like client care, administration, and actually executing on transactions, which would be equivalent to your game day?
Yeah, 100%. I guess just being aware. Really listening to client needs, really listening to what their needs and objectives are. That makes a big difference. And I guess being involved in a team, I've got my team that I run at Azura, and I kind of care for them too because I know that I feel like we win together. I was never one to play golf or boxing, individual sports. So I was always very aware of people and how collaboratively you were better than just the individual.
Yeah. And so you've got a team there. Is that a team that you manage or you're within the team?
Yeah, completely manage.
Manage. Okay.
So I've got a credit analyst team. I've got 2 senior credit analysts. I've got a junior credit analyst. I've got a client manager as well. And we have some shared services at Azura, which is the marketing team, settlements team. So there's a few things there.
And do they have like a market outlook team or an economist that provides you with intel and market outlook about where you see rates going?
No, we don't, but we do share stuff in the group chat every now and then, but maybe you can help us with that.
Well, you could, because one of the most topical things now is the Australian banks are anticipating another rate rise at the next meeting, which I think is crazy at the moment, just given cost of living in Sydney, cost of real estate, cost of fuel, inflation is on the up and up. I was almost going to ask you what your view was on it. But it seems to me that the banks are positioning in that way for another rate rise despite these factors. Are you seeing any signalling or positioning from the banks in terms of raising fixed rates or raising variable rates, I should say, in anticipation of these things?
Yeah. Fixed rates have been a big topic of conversation. And in terms of rates, we obviously get emails or back channel emails from the banks updating, what the commercial bank's outlook is for FY26 and how things are going to go for the rest of the year. So we're constantly in tune with what the banks are saying or where their approach is. I mean, for me personally, like it changes every month. We get a new data set and then they change it. So it's hard to kind of, it just helps with client communication, right? And what I've found is fixed versus variable or different types of rate products is going to come down to more of the personality of the client than it is the actual product itself. If they're ultra concerned about where the rates are going and they want to fix, and that's, they're happy with a set and forget repayment over a fixed period, then great, let's look to do that. But most of the time, my clients are pretty much, let's just ride the variable wave.
Yeah. Yeah, I did. I mean, with my personal home loan, I did half fixed, half variable when I established that. But that was back in COVID.
That was really common back then because the fixed rates and the variable rates were lower, but the variable rates were almost there.
Yeah,
the variable rates a lot lower than the fixed rates at the moment because they're pricing that in.
Yeah, okay. And if you'd asked me probably 2 months ago where we thought rates were going, I would have said up this year, that we're seeing 2 or 3 rate rises this year at least. But now there's been a lot of uncertainty cast with the recent conflict. For the most recent update, did you get an update from the banks at the beginning of March about where they were looking at position things?
So they've all said that they think it's going to go up, except Macquarie.
Yeah, right.
I got an email from Macquarie Commercial just saying that we're impartial. We think they're going to hold.
Yeah.
And then they had the asterisk that said, but there's considerable evidence that it may rise. So it's, pick your camp.
Okay. All right. So in terms of your business and the loans that you're now seeing on, just given the setting that we're seeing now, it's a good blend of clients looking to achieve goals in terms of paying down debt, clients looking to acquire new assets. Is that the bulk of it that you're seeing at the moment?
Yeah.
New things coming through?
Yeah. So I guess to use one of your analogies that I've heard on one of your ads, it's democratize access to lenders and certain strategies. Yeah. And the reality is, like, the traditional banking don't have the same capabilities what they used to. And a lot of wealth or private clients they're so used to what the banking was like 10 to 15 years ago that when they go to the bank to do something or downsize, they've got a $10 million place. They want to go down to a 5 and give some money to the kids. They go and do that, but because they don't have an income, the bank won't let them do that. And then all of a sudden they go, I don't know what's next. So for the advisors to have someone like myself and my team to be able to go, well, hang on, we've got solutions for that. They're quick, they're fast. And more than anyone, like, time kills deals. So if you've got those fast and safe solutions, then clients are going to kind of be happy for it. And so that's just part and parcel of a lot of the transactions that we're seeing these days. So even if they're in, preservation phase, they're still transacting. There's still ways to lend against or gear depending on their risk profile. And we're finding cheap and fast ways to do that.
Yeah, I found that with your group in particular. I would say, like, I've got access to a private banker at every bank, which you'd expect someone running a business like mine. Frankly, I find it much easier to come to someone like you at Azura and say, find me the best rate, because you'll also work through that application process as well to help us get the best deal. And you'll also have a sense of where the best deals are in the market as well. I don't have the same software that you do in terms of price comparisons for what we're looking for as well. And I'd say that the most refreshing thing is when we come to you with something exotic, whether it be for us as individuals or for clients, you're generally able to find a solution.
Yeah, that abstract piece is big. One of our PowerPoints is really just understanding the client need and then being able to create a strategy straight off the bat. So, for example, one of the majors don't lend against bonds. I had a guy who's hit a roadblock because he can't lend against his bonds. I go, mate, you're in the wrong bank. All of a sudden, we've got a solution, and then that develops trust with the client as well as the advisor as well. So he's kind of seen the difference that a broker can make who has access to all those types of different funders and just knows the market. So that we're finding that is a big unlock. Once an advisor works with us once and sees the difference that we make, they go, this is a no-brainer.
Yeah, absolutely. Because that, like you said, time kills deals, and being able to get access to that liquidity when you need it is really critical. If that person is looking to buy an asset, if they're looking to transact on something, in some cases they may not really care too much about the interest rate if timing can help them with the deal.
90% of the time, the time's at the bottom of it. There was one where there was a divorce, and the ex-partner was asked for an appropriate sum of money if he could get the money in time, and so we were able to go to a family office and kind of go, well, here's his asset position. Can you lend against this to give us the money? And the alternative was Does he sell some of his commercial properties? Does he sell down some of his positions in his equities? And pay CGT? There's all these other things that come off the back of that. So for us to be able to come with him with a solution fast, that then enabled that him to meet the demands of the ex-partner, and then him to be able to sell down or deal with that loan in his own time at the back end. And so that was a game changer for him.
Yeah, definitely. Well, if you're saving them the heartache of having to liquidate an asset, it gives them a much better after-tax outcome if they can have some deductible debt.
Big time.
That they can claim against that.
And they understand that. So as soon as they hear the offer or the strategy that we put forward, they go, that's what I'm looking for.
And in terms of your growth strategy with Azura, when you're speaking with groups like ours, is that the playbook for you now to go out and speak with other wealth management groups and build your business? Is that sort of how you see 2026 panning out for you guys?
100%. So as I mentioned before, we can't give financial advice. So we've got to partner up with people who can, because that makes it easy for us to get a brief and a set of objectives or a set of instructions, and then we kind of carry that out. We like dealing with groups like yours because you're nimble, you're a boutique, it's easier to build relationships, you're dealing with decision makers and other business owners as well. So being a business owner myself, there's kind of like that, it's quite easy to build that rapport there. And not every client that they have will be for us, but ones that are, we can show real value. And once we do that first deal for the advisor, we're at the top of their call list.
And are you looking to work with people in a certain geography, or is this an Australian-wide campaign?
No, so Australia-wide. I grew up in Brisbane. I lived in Melbourne for 10 years, and I've been here for nearly 5. So I've got a presence across the East Coast, and it just makes things easier dealing with clients when you've got, I own property in all different states as well, and I've had dealings in all different states. So I've got a guy up in Cairns who's looking to do some stuff, and I used to play, football up there. So, we talked about different fishing spots and, stuff like that. And that just kind of builds rapport and a bit of trust. And it makes the experience a little bit more easier, and it's just a better client experience.
So in terms of you dealing with wealth advisors, when you're coming across clients that are at that preservation stage in their life, how are you transacting with them, and how are you working with the wealth advisors there?
Yeah, so oftentimes they're equity rich, cash poor. And so finding solutions with funders that provide those kind of lending solutions really can help the client. Often these have no income documentation requirements. They don't service the loans. These particular products have like a prepaid or what they call a capped interest. So if you lend out $2 million against a $10 million home over a 2-year term, you pay them back that principal $2 million plus the fees and charges and the interest on that particular on the lending piece there. So as an example, I've got one of the advisors from your group actually sent me this client's got a 9 mil unit up on the Gold Coast, and they're trying to access funding because they don't want to sell it for anything less than 8. But they need living expenses. They want to invest with your advisor, and so how do we get access to that money while they're not working? So we can do an asset lend over a short term, and that allows them to get the money or the liquidity that they need without having to pay monthly repayments, and it enables the advisor to go and deploy some of that cash the way they want to.
So if this person's not working, they don't have an income, but they need to unlock some equity out of a single asset, I can come sit down with you and say, okay, can you make an assessment and look at the different lenders? And in terms of that individual there, then that's giving them real cash that they can then deploy into other risk assets to get it growing for them. What are the sort of interest rates you're seeing on that type of product?
So it depends on the LVR and the type of product. And so obviously the lower the LVR, the lower the rate. And you're probably going to be sitting between anywhere, probably about 8 to 12%. Some needs are actually business needs. So if you've got tax debt consolidation or anything in terms of acquisitions, you might have a big industrial warehouse with no debt on it, and you want to buy another warehouse, or you might want to buy a business. Because that's our business purpose, that's a little bit more expensive than if it was in your individual name or what they call a coded loan. But you can still, the fundamental premise is if there's equity there, we can lend against it. You just need to be very across the exit strategy, or the fact that it's not a 30-year mortgage or a 30-year term. It's going to be a 1 to 2 year term.
And on the flip side of that, we've got people who are still currently working, and we've got clients who are employed by listed entities. So I spoke to someone the other day who works for Microsoft, spoke to someone who works for Snapchat, spoke to someone, I've got clients at Goodman Group. So do you do single stock loans against employee share programs as well if they're vested?
Yeah, absolutely. So we can look at that two ways. One, as the vested shares, we just get the vested schedule, and we can use that as income if they want to borrow to buy property or lend against. We can also lend against the stock itself as long as it's listed.
Okay.
And that was the product that I mentioned earlier, that 3 to 4%, that family office.
Yeah, that's right. So they're looking at, instead of it being collateralized in the form of a margin loan where you've got a portfolio and it could be a broad range of LVRs, this is a single stock loan. And how does that work in a practical sense? Is that where they're effectively off-market transferring the security to the family office and then they arbitrage it?
Yes.
And then that's how you're getting it at the lower rate. Is that how that works?
Yeah, correct. So there is a custody transfer. So it goes, the custody is then taken over by the family office, but then in exchange for the amount of lending that they're going to do against that particular share.
And then, even though we're not accountants, but it's not treated as a sale. I'm pretty confident there's a tax ruling around that, which means they don't have to incur CGT.
Yeah, I think that's why its name's custody, not CGT.
Yeah.
But interesting that you mentioned CGT, because some of these employees, or even the early ones, they've got these big share balances, right? And even on the vested shares, once there's a tax event, because you've got to pay the tax once they do vest. So we can lend against those shares to pay the tax rather than having to reduce your position.
Yeah. Yeah, and that the tax planning side of it's huge. So we see that happen all the time where someone has employee share program, vested shares, they've got to pay a tax bill on it. They might have faith the company's going to continue to grow or a view that it will be an outperforming business. So they ultimately don't want to sell the shares in order to service that liability. And then they can come to you and then get borrow against it.
Absolutely. And a lot of them believe in the business that they're working for, or else they wouldn't be there. So for them to have to sell down, they're doing it because the only way that they know to pay the tax without a real reverberation in their personal position is to pay it down.
And what, I mean, you mentioned 3 or 4% on the single asset stuff and the employee share program loans. I assume that's about the same, right?
Yeah.
And then what are the rates on your margin facilities?
So your bank margin facility is going to sit anywhere between 6.5 to 7.
Yeah.
Depending on the total security amount. So anything under 5 mil, you're probably looking at the higher end. Anything above 5 mil, you're looking at the lower end of that 6.5.
All right, guys. Well, Reuben, thanks very much for joining us.
Pleasure.
Looking forward to keeping up with the work with you. And thank you to everyone for joining us for another episode of Upstream with RiverX.